$5,181. That's the maximum Social Security check the government will mail one person in 2025. And it's not going to you. Not because you didn't work hard enough, not because you didn't earn enough. Because 3 IRS-adjacent rules buried inside your earnings record quietly disqualified you decades before you ever filed your first claim. Gerald Meacham, 69, from Scottsdale, Arizona, spent 44 years as an electrical engineer, pulling six figures for the last 15 of those years. He expected a check near the top. What showed up in his bank account on February 3rd was $2,740, roughly half of what the system's ceiling allows. Gerald didn't make a mistake. The formula made the decision for him. And unless you understand exactly how that formula works, and where it punishes high earners just as brutally as low earners, you're walking into retirement with thousands left on the table every single year. Here's what the Social Security Administration won't print on your statement. The $5,181 maximum isn't a reward for loyalty. It's an engineered output of three variables, and missing even one of them by a single year or a few $1,000s drops you hundreds of dollars per month, permanently. The Social Security Administration calculates your benefit using something called the primary insurance amount, your PIA. That PIA is derived from your average indexed monthly earnings, which the SSA calls your AIME. Your AIME is not your average salary. It's not your best year. It's not your last decade. It's a 35-year rolling calculation that takes your highest earning 35 years, adjusts them for wage inflation using the National Average Wage Index, adds them together, and divides by 420 months. If you worked only 30 years, the SSA doesn't just skip those 5 missing years. It plugs in 5 zeros, 5 years of zero income averaged across your entire career. That single rule, the 0-year penalty, costs the average early retiree between $280 and $460 per month for life. And it's not disclosed in your annual Social Security statement. Nowhere on that green and white projection does it say, "Warning, this estimate assumes you will work 5 more years. If you retire now, subtract $300. To hit $5,181 in January 2025, a person needed to satisfy 3 conditions simultaneously. First, they needed maximum taxable earnings for at least 35 years, meaning they hit or exceeded the Social Security wage base cap every single one of those years. Second, they needed to delay claiming until age 70. Third, they needed their earnings history to align with specific indexing years that the SSA updates annually. Miss any one of these and the number drops. Fast. If you're over 60 and you haven't pulled your full earnings record from the SSA, not the estimate, the actual record, then the next 12 minutes could show you exactly where your money went and whether you can still recover part of it. I'll also explain a strategy in the second half of this script that even some CPAs get wrong, involving the interaction between your AIME and the bend points that most people don't discover until after they've already filed. The first gatekeeper standing between you and the maximum check is the Social Security wage base. In 2025, that ceiling sits at $176,100. Every dollar you earn above that number is invisible to Social Security. You don't pay FICA on it, and it doesn't count toward your AIME. But here's the trap. That ceiling wasn't always this high. In 1990, the wage base was $51,300. In 1980, it was $25,900. In 1975, it was $14,100. So when the SSA calculates your 35 best years, they're not looking at raw dollars. They're applying the National Average Wage Index to adjust each year's earnings relative to the year you turned 60. The formula is precise. Your earnings in any given year are multiplied by the ratio of the average wage index in the year you turned 60 divided by the average wage index in the year those earnings occurred. This means someone who earned $48,000 in 1990 might have that year indexed up to $108,000 in today's terms. But someone who earned $52,000 that same year gets no additional credit above the $51,300 cap, no matter how the index adjusts. Sandra Ellison, 66, from Richmond, Virginia, earned between $45,000 and $72,000 for most of her career as a hospital administrator. She assumed her best years were the last ones, 2018, 2019, 2020, when she was earning $89,000. After pulling her actual earnings record through her My Social Security account at ssa.gov, she discovered that her 1998 earnings of $61,000, once indexed, were actually worth more to her AIME than her 2019 earnings. Her highest value years weren't her highest salary years. That distinction matters enormously. The second gatekeeper is the 35-year requirement. Not 30, not 33. Exactly 35 years of covered employment. The SSA takes your 35 highest indexed years and averages them. This creates a cliff. Year 34 of work contributes fully, but if you retire at year 33, 2 zeros enter the formula. Each 0 year dilutes your AIME by approximately 2.8%, which translates to roughly $70 to $95 less per month in your final benefit, compounding over a retirement that could last 25 years. Thomas Brennan, 63, from Boise, Idaho, planned to retire at 62. He'd worked since age 22, that's 40 years, well past the 35-year threshold. He thought he was safe. What Thomas didn't account for was that 3 of those years, 1982, 1983, and 1984, he earned less than $4,000 each year while in graduate school. The SSA still counted those as his years of work, but their indexed values were so low they actually dragged his AIME down. His financial planner suggested something counterintuitive. Work 2 more years at his current salary of $94,000, and those new high-earning years would push out the 3 low-earning years from the 35-year window. The net gain, $187 per month for the rest of his life. I'd be curious to know, have you actually logged into ssa.gov and checked your full earnings record year by year? In our previous video on AIME calculations, over 300 viewers commented saying they found errors on their records, years where employers reported 0 or reported the wrong amount. One woman found a $12,000 discrepancy from 2003 that had been sitting uncorrected for over 20 years. The third gatekeeper, and this is where it gets surgical, involves the bend points. The SSA doesn't replace your income on a straight percentage. Your PIA is calculated using a tiered formula that changes every year. For 2025, the bend points are $1,174 and $7,078. The first $1,174 of your AIME is replaced at 90%. Every dollar between $1,174 and $7,078 is replaced at 32%. Every dollar above $7,078 is replaced at only 15%. Wait, it gets worse. Those bend points mean that the system is structurally designed to penalize high earners on a percentage basis. A person with an AIME of $3,000 gets about 55% income replacement. A person with an AIME of $11,000, someone who maxed out the wage base, gets roughly 28% replacement. The system gives you a larger check in absolute dollars, but proportionally, it's squeezing you harder the more you earned. None of what I just explained accounts for the single biggest lever, and the one most misunderstood by seniors and their financial advisors alike. Delayed retirement credits. For every month past your full retirement age that you delay claiming Social Security, your benefit grows by 2/3%. That's 8% per year, compounding monthly, between age 67 and 70. It's not an investment return. It's a permanent actuarial adjustment baked into every check for the rest of your life, and in many cases, into your surviving spouse's check after you die. The math is blunt. A person entitled to $3,800 at age 67 who waits until 70 receives $4,712, an increase of $912 per month, or $10,944 per year, for every year they remain alive past the break-even point. The break-even point, the age at which total dollars collected from waiting finally exceeds total dollars collected from claiming early, is approximately 80 years and 4 months for most claimants. According to the SSA's own life tables, a 67-year-old male has a 60% chance of reaching 80. A 67-year-old female has a 71% chance. Those aren't coin flip odds, they're majority odds. Donna Whitfield, 70, from Eugene, Oregon, waited. Her husband Larry, same age, didn't. He claimed at 62. His monthly check, $1,880. Hers, $3,940. They worked similar jobs for similar durations in the same school district. The only difference was timing. 8 years of patience translated into $2,060 more per month, $24,720 per year, entering their household. Larry's decision can't be reversed. It can't be undone. Form SSA-521, the withdrawal of application, is only available within 12 months of your first claim. After that window closes, the number is permanent. If any of this made you pause, if you looked at those numbers and realized your own decision might be costing you or saving you more than you thought, tapping the like button takes 2 seconds, and it signals the algorithm to push this information to other retirees who are running out of time to make this same choice. That matters more than you think. Now, getting to $5,181 requires something even beyond delayed credits. It requires hitting the absolute maximum AIME, which in 2025 means an AIME of approximately $11,600, and then applying the full 24% delayed retirement credit on top of the PIA that produces. I'll break down exactly who qualifies for this in the next section, and more critically, what happens when you're close but not quite there. Because the gap between $4,200 and $5,181 is where most high-earning retirees actually land, and there are specific moves that can close it. The person collecting $5,181 per month in January 2025 is not typical. They are, statistically speaking, a unicorn. They earned at or above the Social Security wage base for 35 consecutive years, they delayed benefits until exactly age 70, and their indexed earnings happen to align with peak National Average Wage Index years. Some economists argue this threshold was engineered more as a political talking point than a realistic target, a way for Congress to say the maximum benefit is generous, while knowing fewer than 0.4% of claimants will ever touch it. But here's where this becomes practical for you. You don't need to hit $5,181 to benefit from this knowledge. The same mechanics that produce the maximum check produce incremental gains at every level of the benefit spectrum. And most of those gains are recoverable if you act before certain deadlines. Imagine you're 64. You've worked 32 years. Your current estimated benefit at 67 is $2,600. 3 years of additional work at your current salary doesn't just add 3 more earning years to your record. It potentially replaces 3 lower earning years in your 35-year window, and it eliminates what might have been 0 years if you had fewer than 35 years of covered work. The combined effect could push your benefit to $2,870 or higher, a $270 monthly increase that over a 20-year retirement represents $64,800. Victor Samuels, 64, from Charlotte, North Carolina, ran this exact calculation with his CPA using the SSA's ANYPIA calculator, a free tool the administration makes available but never promotes. His CPA found that by working until 66 instead of retiring at 64 and then waiting until 70 to claim, Victor could push his benefit from $2,480 to $3,310. a swing of $830 per month. Not theoretical dollars. Actual dollars deposited into his account every month until he dies. The Anipia calculator is available at ssa.gov/OACT/Anipia. It's not user-friendly. It looks like software from 1997, but it's the same engine the SSA uses internally. Some tax professionals disagree on whether the ANYPIA outputs perfectly match final benefit calculations. The SSA has acknowledged occasional discrepancies related to indexing year updates, but it remains the most accurate public tool available. Now, there's a wrinkle that catches high earners off guard. If you're still working while collecting Social Security before your full retirement age, the retirement earnings test applies. In 2025, if you're under FRA for the entire year, the SSA deducts $1 from your benefit for every $2 you earn above $23,400. In the year you reach FRA, they deduct $1 for every $3 earned above $62,160. This isn't a tax, it's technically a withholding. The SSA recalculates your benefit at FRA and credits back the withheld months. But the cash flow disruption is real, and many seniors perceive it as a permanent loss because nobody explains the recalculation clearly. I know this sounds like a maze of numbers with no clear exit. It's dense. The formulas interact with each other in ways that even trained professionals sometimes miscalculate. But here's what matters to you specifically. Your AIME is the single number that determines your financial life in retirement, and it's built over 35 years, which means every year of your working life either strengthened it or weakened it. The question is whether you can still adjust it before you claim. If you've made it this far into this video, you're not a casual viewer. You're someone who actually wants to understand how your own money works. Subscribing means you'll see the follow-up I'm releasing next week on IRS, Form 1040-SR, and the 6 deductions that directly reduce how much of your Social Security check gets taxed back. That video connects directly to everything we've covered today about maximizing the check before the IRS takes its cut. One more critical factor that most people tune out on because the terminology sounds bureaucratic: the cost of living adjustment, or COLA. Don't skip this. The COLA is applied to your PIA, not to your total benefit after delayed retirement credits. This means the compounding works in your favor. Your PIA gets the COLA increase, and then the delayed retirement credits are applied on top of the COLA adjusted amount. In 2025, the COLA was 2.5%. On a PIA of $3,500, that's $87.50 added before the delayed credit multiplier kicks in. Over a decade of COLAs, that sequencing generates hundreds of additional dollars per month compared to what most people expect. Margaret Cho, 71, from San Jose, California, filed at 70 in 2024 after delaying from her FRA of 67. Her PIA at 67 would have been $3,340. 3 years of COLAs between 67 and 70, 8.7% in 2022, 3.2% in 2023, 2.5% in 2024, pushed her PIA to approximately $3,820 before the delayed credits applied. Then the 24% delayed credit boosted her actual benefit to $4,737. If she had claimed at 67, she would have received $3,340. The difference, $1,397 per month, or $16,764 per year, came from understanding the sequencing, not from earning more money. Now here's what almost nobody connects, and this is where Gerald's story from the opening comes back into focus. Gerald earned 6 figures for 15 years, strong salary, but his first 20 years of work, from 1976 to 1996, he earned between $18,000 and $45,000. Those early years, even after indexing, couldn't compete with maximum wage-based figures because he simply wasn't earning at the cap during the decades when the cap was lowest and easiest to hit. The irony of Social Security's formula is that it rewards consistency over peak performance. A person who earned $70,000 every single year for 35 years often ends up with a higher AIME than someone who earned $30,000 for 20 years and $140,000 for 15 years. The 35-year average punishes late bloomers. Gerald's second mistake, he claimed at 66, 1 year before his full retirement age of 67. That single year of early claiming cost him a 6.67% permanent reduction. On a PIA of $2,930, that's $195 per month, $2,340 per year, gone. Not temporarily, permanently. Across a 20-year retirement, that 1-year early decision cost Gerald $46,800. The thesis of this entire video is harsh but accurate. The Social Security system doesn't reward you for working hard. It rewards you for understanding its formula and timing your decisions with mathematical precision. The people collecting $5,181 aren't smarter than you. They aren't luckier. They simply had 35 years at maximum taxable earnings and the financial runway to wait until 70. The system was built to produce one specific output for one specific input, and everyone else receives whatever the formula decides they deserve. Here's what you should do this week. Monday, log into ssa.gov and download your complete earnings record. Don't look at the estimate. Look at the actual year-by-year numbers. Check every year for accuracy. If any year shows 0 or an incorrect amount, file Form SSA 7050 to request a correction. Tuesday, count your years of substantial earnings. If you're under 35, calculate exactly how many more years you need and what those years would replace in your current 35-year window. Wednesday, pull up the ANYPIA calculator at ssa.gov/OACT/NEPIA and run your numbers. Input your actual earnings history. Then run it again with 1, 2, and 3 additional years of work at your current salary. See the difference. Thursday, look at your full retirement age. Check your birth year against the FRA table in SSA, publication number 05-10035. Then calculate your benefit at FRA at 62 and at 70. Write those 3 numbers down. The gap between them is the cost, or the reward, of your timing decision. These 4 actions take less than 3 hours total. They cost nothing. And the difference between doing them and not doing them is potentially 6 figures over the course of your retirement. That's not speculation, that's arithmetic. Gerald Meacham eventually hired an independent Social Security analyst, not a financial advisor who sells products, but a fee-only consultant who charges $400 for a claiming strategy session. That analyst identified 2 things. First, Gerald's 1988 earnings were misreported by his former employer, showing $32,000 instead of his actual salary of $47,500. After filing a correction with supporting W-2 documentation, Gerald's AIME increased by $44 per month. Second, the analyst calculated that Gerald's ex-wife of 14 years, from whom he divorced in 1999, had a higher earnings record than he realized, and Gerald was potentially eligible for a divorced spousal benefit that exceeded his own reduced benefit. The SSA doesn't notify you about divorced spousal benefits. You have to know to ask. The process took Gerald 4 months, 3 phone calls to the SSA's national line at 1-800-77-21213, and 1 in-person appointment at his local field office. His benefit increased from $2,740 to $3,085, not $5,181, but $345 more per month than he'd been receiving, $4,140 per year he'd been leaving uncollected. You spent 35 years or more building your earnings record. Every paycheck, every overtime shift, every year you showed up. It all fed a formula that most Americans never see explained clearly until after they've already locked in their number. In the next video, I'm covering the provisional income thresholds that determine whether 50% or 85% of your Social Security check gets taxed by the IRS, because the check you receive and the check you keep are two very different numbers. And the rules governing that taxation changed more than most people realize. That video drops within the next 7 days. The $5,181 check exists. It's real. But the system that produces it was never designed to help you reach it. It was designed to make you think you couldn't.